All right, Neil. Well, we're back to discuss some more things all related to Regency Capital, markets. But first, we're going to start with a question that I have about the Harvard Crimson. I notice you're wearing a Crimson sweatshirt over there. You don't rep Harvard as much as you should. You're a little, more humble than you also should be. But I've noticed or I've read that there was a recent football hire. You're an ex-captain and quarterback of the Harvard football team. What's going on over there at the Stanford of the East?
Yeah. These are dark days at the Stanford of the East. Harvard seems to be pretty good at riling up its alumni and putting themselves in very controversial situations. First with Gaza and then another scandal. And then yesterday's Wall Street Journal had an article. I'm surprised it made national news, but the new Harvard football coach was announced, and uh, it was a surprise pick, given that so many were behind the defensive coordinator. Good guy, good coach. He was a few years older. I overlapped with him just a little bit. But he was a favorite, and the athletic director went way out of the box, hired a position coach from Rutgers, a former Princeton football player, which some had
Woo!
argued that was a disqualifier by itself. But um, no,
That
but
cuts deep.
so yeah, I mean the the athletic director, uh, who hasn't been at Harvard long, and she's an outsider. She's making a bet, and so actually have high hopes for this new coach. And of course, we many of us were backing the guy we knew, and a great coach. And he will be a head coach somewhere someday. Um, but now we have a coach, and he's our coach, and we've got to back him in the program. But there are a lot of the Wall Street Journal article talked about these a lot of these alums who have swore off donating to the school or the program going forward. So yeah, these are dark times morale wise.
I'm not gonna ask whether or not, you were on that list, but I have an assumption there. But
But
anyways, let's
well,
wrap it up on
I
more.
well for the record. So yeah, at the 11th hour, when first of all the news of this leaked, it wasn't an official announcement, but the school paper, to their credit, had the scoop, and one of the captains, just in the course of I think half a day, got on the horn, and 20 former captains representing I think 21 years of Harvard football, because there's only one captain per season. Um, said okay in terms of putting their name behind Scott Larkey, and to our surprise, he didn't get the job. But anyway, that's behind us and
Well,
looking forward, and
you
it's
know,
business as usual from here on out.
let's end that topic with just a shout out to Coach Murphy on a great career. Now he was your
Yes,
old coach,
30.
and
Yeah, I can't believe I didn't realize how early in his career I was there. Because you get to a program with a coach, and you never think about how long they'd been there or their career journey, career arc. Uh, he was a head coach at Cincinnati and got to Harvard, I think, in 94, 95. And so it was just a few years later that uh, I got there. And yeah, so anyway, he quit 30 years, the winningest coach in Ivy League history. And um, just a lot of gratitude to that guy and his coaches for, what they did for all of us dumb kids, because um, they did some great things for us.
all right, so let's kind of transition now to what we're doing now, similarly to how you transitioned after Harvard straight into the investment world. Um, in the last discussion and recording that we did, we alluded to some performance topics. Always kind of a fun topic for everyone, just in general. Um, Also, not an easy topic of discussion as well, which also makes it, fun and intriguing. We're at a little bit over 3 years now at the firm, Regency Capital. I'm sure for you, I've
Wow.
been here, about half of it now. It's gone quickly for you. How's it been going? Give us
Yeah, I
a
was just
quick update, and then
yeah, I was just
forward the
saying,
performance discussion a little bit there.
I was just alluding to how time flies. 3 years plus. No, it's been a great ride, and thanks to you and Arthur and Kayla and all the others who really helped us get to this. I mean, this has been quite a dream. Um, yeah, performance is always something we're talking about. I have always pledged not to hide from performance, good, bad, whatever. It needs to be discussed both for just the raw data, but also the context um, of clients and the questions that they really have, which is, well, am I getting closer to my objectives, or or further away? So, on that note, and 3 years is a good time to look at past numbers and such. And, thankfully, knock on wood, across strategies, we've been very fortunate. From our biggest strategy, the absolute return has done a lot better than I thought it would, given my own expectations for the things that happened in 2022 and lower returns in general. But across the board, from income over 3 years, and I'm going to give numbers just because it can't be vague on these. They're numbers. That said, our business is very regulated, and the disclaimer that these are our strategy or composites numbers. There are footnotes that are required, and anyone's free to get them from us. So I'm talking generally about performance, but also I'm giving numbers just because I don't know how else to go about it. But you take income where after 3 years, we're up almost net of fees up 6% over 3 years, which is not great if you think about 3 year time. But the benchmark that it's compared against, because this is an income product, so the bond benchmark that it's compared against is down 9.6% over 3 years. Right. So again, upending this idea that bonds and income in general is lower risk. It's not necessarily so, especially when interest rates are so low. But
So
yeah, if you're an average, just about any bond fund or 3 years, you're negative.
that's exactly what I was gonna allude to,
Right.
right? That was gonna be my question.
So
Simplify this for everybody. It's if you're in fixed income funds, more than likely you're gonna be down.
right. And
Especially
down
because of
about 10%.
2022. Yeah.
Yeah.
Yeah, a good
And
amount.
2022 was a big deal. I mean, that was a really big deal. And we're positive. That's great. Uh, but just even looking at the equity side, over 3 years, outperforming their various benchmarks, global stock portfolio, and then our all stock portfolio, which is really, over time, we want to gauge it to the S&P 500. Doing fine, doing, better than fine, especially given, what we talked about in the last talk, which was not having all this tech. So I feel like we've gone there. We've gotten, decent returns with, importantly, a lot less risk. And we're always going to look at things in a risk adjusted way, but looking at the absolute and relative numbers, I'm again pretty happy. I don't think there's a single situation where clients are now further away from their objectives, uh, especially most clients, which is retirement and expanding their margin of safety and their financial cushion. I think we've gone there, but I'm surprised. It's always nice to start off strong. I'll say we did that, even though, uh, as you know, I'm always thinking about the things that I got wrong, and so I don't, on purpose, I don't look at numbers too much. I don't want to get sort of caught up in trying to be absolutely perfect and zigging and zagging on all that. So I don't look at numbers all that often. But after 3 years, I think it makes sense to look at them. What are they? And look at the various risk-based measures for performance. But it's kind of nice that the multi-asset portfolios we're up about let's see, balance is up 19% gross, 17% net. The benchmark is up 7. And our absolute return, which doesn't have a benchmark, it's absolute return, which the plurality of our clients are in. That's up 14% over the last 3 years, and And again, this is with 2022, which was as bad a year for bonds and even balanced portfolios as you got. So we've seen bull market, we've seen bear market, we've seen bull market again, and this is where we're at. So again, I'm pretty happy with numbers. We're still diving into the hows and whys. I think it's important just to see what we got right, what we got wrong, and uh, what we can take away from that. Got to watch the tape, as we say, in football. But yeah, so far so good.
Yeah, it's awesome to hear. I think it's been an interesting kind of entrance into this, I guess, this new career for me, kind of various types of business cycles and markets, and it's been a great learning experience, and it's been neat to see the numbers on both sides of that, I guess, and for someone that's as humble as you to be happy with it, and obviously you caveat that by, you know, never being fully satisfied and, making mistakes and learning as well. But for you to be pretty satisfied
Well, I
is
don't want to say I'm
nice.
not satisfied or happy about it. It's it is what it is. I'm more again, it's been 3 years. I'm just happy with everything that's gone on in 3 years, and I um obviously have more at stake now, and no one but to blame but myself now, and so part of it is relief, and yeah, all things equal, you want to see some validation what you're
Sure,
doing,
sure. I
because
mean,
inevitably, I'm sure people out there wondering about the road not taken. But I think when it comes to the area of performance, I we I think things have gone as well as I could or should have expected. Um, to be honest, like always, I just want to avoid disaster more than anything else, because that is actually the way you make money and compound returns over time. Um, but yeah, it is what it is, and I'm just more happy and excited that we have some real data to look at, parse through, and we got some scores on our permanent record.
yeah, no, it's great. And I think obviously returns and performance, most important thing that we do, but amongst many other value, that we can add for the clients and just making their lives better and easier. But like you said, something that I've learned is that we're not going to shy away from it. We're not going to shy away from that discussion. Confident in a lot of our processes and thoughts behind the portfolios, and so that's been neat for me to learn about. And it's tough. I mean, I think in this new age, I guess it's not too new, but everyone can see the stock market and percentages and numbers at every second of the day, and everyone can see various articles and different types of information, and so everyone has their own ideas on performance, what's good, what's not, what's bad. We all have our own emotions as
Mhm.
well. We get caught up in greed and having everything at our fingertips and wanting performance so quickly. How do you as a manager maintain that long-term perspective? And this is something that I've learned quite a bit from you and something I'm very grateful for, but how do you thread the needle or tiptoe that line between, not getting caught up in short term, or how you look at that versus the long term?
Uh, Painfully and not well enough is my answer. Yeah, it's the hardest thing, is not necessarily finding what to invest in. It's controlling your own emotions and fears. And let's face it, we're all human. We are fight or flight creatures by nature. Uh, that's our biology. And so we are, we've evolved, or I should say, we haven't evolved so much from, the animal world. But the problem with fight or flight is it makes it very hard for humans to think. And that's the main thing. And so that's something that I've tried to work on over time. The only way to do it is to work at it, put things in perspective, even, um, just like with any anxious brain, you, you have to sort of talk yourself or remind yourself and talk yourself out of doing sometimes what your biology wants you to do. And that's not easy, but, I've tried to do things that, have made me better at it than before. I would say a little more perspective, a little bit more, a cleaner way to rationalize things, and more process driven. And I think that's made all the difference. But that'll continue to be the main objective is controlling emotions, because I mean, that's the boogeyman. That is what is between us and the real secret sauce, which is time, and time in the market, time in markets, not interrupting compounding needlessly. Um, we're not going to assume we can walk through a rainstorm and not get wet. But we can, if we can take some precautions, think things through beforehand, be smart about it, i.e., wear a raincoat, have an umbrella. I think, I think we're really doing a service.
Yeah, I think that everyone hears the topic of compounding, time in the market, but nobody actually, I don't know, not nobody, but people don't often stop to necessarily think long and hard about what that means and the decisions that you need to go into that type of philosophy or thought process. So I think that this discussion is extremely valuable, and I think it probably doesn't happen enough between advisors and clients. Uh, and just to, make sure that investors out there, whether they're doing it on their own or with a company, money management company, that they understand these types of things really well and know that whoever is helping them, has their back and thinks through some of these processes. I don't know.
And has a
This is a
process.
very nuanced,
Yeah,
like fun discussion that not too
right.
many people address.
Well, that, and just talking about process. I mean, everyone talks process, but they don't really talk process, right? So
Exactly.
what does that process mean? And some people's process, to be honest, is just shooting from the hip. And I just think, we have to do everything we can to sort of set ourselves up for success, and part of that is doing things that make it harder and harder to get in your own way. So I do things that I read the same books sometimes. Um, it's kind of like going to church in a way. um, just first principle stuff. I even refer back, it's funny. I always hate what I write, but I go back to this sometimes, because sometimes I look at it like it's brand new, because, I just didn't look at it much for a long time. And I put in there those principles, and, like everything, I wrote this for me. And so, principle number one really is just, why we invest, right? The miracle of compounding. Um, and if anybody needs this book, let us know. I don't know if we sent it to people. It's something we've had around the office, so people have come, have gotten it. But, in this little, booklet, it's among other things, it's these principles, and I have to go back to them just to put things in perspective, and that's part of my personal process. But yeah, we can go on and on about process. It's just important, and no two people have the same process, and that's where it's good to do some homework, some research, ask questions about process. Not just, a lot of people performance chase. Again, that's part of our biology too, but I think more important than short-term performance is really understanding process and understanding the downside. Okay, their process, if they fail, when they fail, I should say, because we're all going to fail from time to time. What does that look like, or what are the odds it looks like? So, we have to think probabilistically, and and really, really think about failure a lot, because we can't control much, but we can kind of tilt to how we're going to succeed and fail, especially
Sure.
the failure part.
I think that's great. I think just a deep insight into, yeah, those processes that eventually play out in performance. That's why we're having this discussion. Any other last kind of tidbits on performance that maybe we haven't touched upon yet?
No, I think, as always, I think the secret to happiness is low expectations, right? So I never go into any particular year thinking, oh, this is going to be a huge year for us performance wise. That said, I am only getting more excited about the prospects for income. I've spent now almost half of my career in an environment where there was no interest to be had, no yield, and I've seen what people have done to get some sliver of yield or some yield, and people have lost a lot of money chasing yield. Um, but when interest rates are going up and you're not caught in a bunch of longer term debt, like some bond portfolios or definitely banks as a whole in their balance sheet, uh, every day seems like Christmas because the risk-free rate is still 5.4%, and the longer term bonds are going up. So we don't have very much in there. So it's nice over time to be able to lock in yields and even inflation adjusted yields, uh, you know, for a more longer term. And I think, if you'd asked me even 5 years ago, would a balanced portfolio or a bond portfolio be throwing off, about almost 5% a year in cash, just income, dividends, interest, all that stuff? I would have said there was no way. But here we are, and so I'm I do have expectations for yield, or at least I'm relieved that that picture going forward looks a lot better than it used to.
Yeah, I'm happy you brought that up, I guess, because I've actually gotten a lot of questions about the income portfolio, whether it's from people that are just really conservative and just aren't interested in equities, or yeah, and from people overseas as well. Some of my friends internationally that are interested in just generating some income off of a portfolio, and so that's interesting insight. One last follow-up question to that is, what's the timeline to some of these portfolios, or how long can we expect, that excitement to continue? If someone were to come to us and be like, yeah, I want to yield 3 to 6% for as long as we can. I mean, what's your response to that?
Well, I think context is everything. So when someone says I want 3% or 4% or 5%, and they say they want it for a long time, then you have to sort of peel back the implicit assumptions that they have. So I would say if you want 5% over time, it means that you think inflation won't change very much compared to where it is today. You're going to get a
Mm,
real yield um, from these securities, and because all that yield represents is what you can lock in between now and then. As interest rates move, the price of those securities can go up and down, but you're sort of guaranteed an income stream if you hold it, which most people, and rightfully so, hold bonds to maturity. So
right.
if they're willing to make a bet about inflation, or this is why probably people buy annuities, because they want yield, and maybe they have or haven't thought about their own assumptions or the assumptions they're buying into about inflation and real yield. But if someone says, "Hey, I'm willing to make that bet," let's lock it in now. I tell them, "Hey, it's getting easier and easier to do so," and you can even do it in a way that maybe allows for some upside too, if inflation is bigger than 2% over the longer
Yep.
term, things like that. So again, nice time to be a bond investor or income investor. And again, it should put some things in perspective in terms of opportunity cost, in terms of, you know, uh, everything, whether it's stocks and PE, or you're looking at real estate and cap rates. Interest rates are huge in determining what a reasonable person would think they're worth, right? If you got this property that is yielding 2%, okay, that's not great, right? When you can make 5.5 risk free, and that 2%, mind you, is if it's rented out 12 months of the year.
Yeah.
So, we're seeing those kinds of assets coming down in price as interest rates have gone up and stay up longer than people expect. So, uh, but yeah, I mean, wrote a piece called, what was it? Springtime for Income and it's what it feels like. It is sort of springtime for the income investor.
Awesome. Thanks for that insight. Yeah, I mean, even looking at it or comparing to a real estate rent perspective is pretty interesting too. So
What would you be happy with return wise? Like if you had to 20 years, you had to go to prison and you had to lock in a yield and the problem is if you went over it, chances are pretty good that you wouldn't make it. If you went under it, or under some level, then you would get some FOMO and you'd be missing out on some things, or you'd have some regrets after you leave prison. But like if you could put everything on ice and capture a total return, not just yield, but a total return, what would you be happy with personally?
I don't know, 8 to 10,
Yeah. Yeah.
something like that.
Yeah.
What about you?
Oh, I think, I mean, 8 to 10 will, you know, pretty much avert failure. And it's probably more doable now than it was over the last few years. So yeah, again, I'd be happy with that. I would be, to be honest, I'd be maybe using my own conundrum or my own dilemma or restrictions maybe to my favor, which is, hey, if I can't change it for 20 years, maybe I go higher, right? Because I'm gonna see and feel the valuations and fluctuations and volatility, but there's not a darn thing I can do about it. And that might be the best thing. I don't know. But I would think for not changing anything and therefore taking on volatility or the ability to take on volatility, if involuntarily, I'd probably shoot for 10 plus, especially if I got to pick the stocks that I was going to ride for 20 years. Yeah,
That makes
I'd,
sense.
I'd
And
go,
I
I'd
think the
go, I'd go
timeline,
north of
that
10. Yeah.
timeline, and I'm younger than you too, so maybe I gotta be a little more aggressive in that thought process. Um, but thanks, Neil. We'll get on again soon and give the people what they want.
All right. Thank you. Appreciate it.